Hello, friends. The next time someone hands you a clipboard at a bank, a hospital, an insurance office, or a real estate attorney, do not sign a single thing until you watch this. Buried inside those stacks of routine-looking paperwork are documents that seniors sign every single day without knowing what those pages actually take away from them. Some of those documents quietly hand over your legal rights, give institutions permission to overcharge you, and one of them can cost you your home if you are not careful. Today I am going through 6 specific documents, what they actually say, why institutions count on you not reading carefully, and exactly what you should do instead every single time. Stay until the end, because the last document is the most important of all 6, and I will tell you exactly why that one matters more than the others in just a moment. Before we get into it, subscribe to this channel right now, and please turn on the notification bell so you never miss an update like this one. The financial and legal traps I cover here are ones that institutions will never explain to you themselves, because explaining them clearly is not in those institutions' interest. The people who are subscribed and watching here find out before the damage is done, so subscribe now, and let's get into all 6 of these documents together today. And before document number 1, let me tell you what document number 6 actually involves, because it is one that a vast majority of well-meaning parents sign without realizing the danger. It is a piece of paperwork that feels like a gift to your children, but it can result in losing your home because of your child's divorce, debt, or a lawsuit that has nothing to do with you. Stay with me until we get there, because that one alone is worth every minute of this video for any homeowner watching right now. Document number 1 is the Overdraft Protection Opt-in form at your bank, and this one costs seniors on fixed incomes real money every single month without them realizing it. When you open a checking account, your bank will almost certainly ask you to sign up for overdraft protection, and they describe it as a helpful safety net for moments when a purchase might exceed your balance. What they do not describe clearly is what that safety net actually costs you, and the number is one that would stop most people cold if they heard it up front before signing. Under federal law, specifically Regulation E, banks are required to get your explicit written consent before they can charge you overdraft fees on debit card transactions, so they cannot enroll you automatically. Here is what you are actually agreeing to when you sign that form. If your debit card transaction exceeds your available balance by even $1, the bank processes it and then charges you a fee. At many of the largest banks in the country, that overdraft fee runs up to $35 per transaction, which means a $4 cup of coffee when your balance is $3 costs you $38 total. If you have 3 small transactions in one day that all overdraft, you are looking at over $100 in fees for purchases that may have totaled less than $20 combined. The alternative, which the bank will not volunteer to tell you, is simply not signing that opt-in form in the first place, because declined transactions at the register are completely free. For seniors on fixed incomes who are managing their spending carefully, the math here is clear. Do not opt in to overdraft protection, because a declined card is inconvenient, and a $35 fee is not. If you have already signed this form at some point in the past, you can revoke it at any time by contacting your bank and requesting to opt out, and the bank is required to process that revocation. Document number 2 is the binding arbitration clause that is buried in your bank's deposit account agreement, and most people sign it without ever knowing it is in there at all. When you open a bank account, you sign a deposit account agreement that is typically dozens of pages long, and most people sign the signature page and never read a single word of the rest of it. Buried somewhere in that document is a mandatory binding arbitration clause, and by signing the agreement, you are giving up your legal right to ever sue that bank in a court of law. If you have a dispute with the bank, a billing error, unauthorized charges, or discriminatory practices, you must take it to private arbitration instead of going before a judge and a jury of your peers. Here is why this matters beyond just your individual situation, and the numbers on this one should make every person watching very angry about what these clauses actually do to consumers. According to CFPB data, at least 6.8 million consumers received cash relief through class action lawsuits against financial institutions, compared to just 16 people through private arbitration over the same study period. Class action lawsuits are how banks have historically been held accountable for large-scale misconduct, and arbitration clauses exist specifically to prevent exactly that kind of consumer accountability from ever happening. Here is what most people do not know. Some banks allow customers to opt out of the arbitration clause if they send a written letter within a specific window after receiving notice of any update to the clause. The practical step is to search your own bank's name plus the words arbitration opt-out to find whether a current process and mailing address exist for your specific institution right now. When you find the address, send that letter by certified mail so you have documented proof of delivery, because this costs a few dollars and can preserve legal rights that are worth thousands of dollars. Document number 3 is the Surprise Billing Protection Form at hospitals. And since the No Surprises Act became law in 2022, this one has become one of the sneakiest documents in any intake packet. The No Surprises Act gives patients federal protection against unexpected bills from out-of-network providers at in-network facilities, and that protection is significant and real for every patient who walks through those doors. But hospitals found a legal workaround, and that workaround is a document called the Surprise Billing Protection Form, also called the Notice and Consent Form, that quietly waives your federal protections for a specific procedure. When a hospital hands you this form as part of your intake paperwork before a scheduled procedure, what they are asking you to do is voluntarily sign away the federal protection you would otherwise automatically have. Once you sign it, if an out-of-network specialist walks into your procedure room, the bill for their services is no longer their problem. It becomes yours, and it can be very large. The form is legal, and the hospital can offer it. But what the hospital is not required to tell you is the single most important thing about it. You do not have to sign it. For emergency care, the No Surprises Act protection applies automatically, regardless of anything you sign. And for planned procedures, you can simply decline to sign this form without losing your right to care. If you do sign anything financial before a procedure under any kind of pressure, write right next to your signature these exact words. Signature for treatment only. I do not authorize out-of-network charges. Document number 4 is the binding arbitration agreement at hospitals and medical facilities, and this one is completely separate from the billing form, even though they often sit right next to each other in the same packet. This is a legal agreement buried in intake paperwork that requires any dispute you have with the hospital or its staff, including a medical malpractice claim, to go through private arbitration rather than a jury trial. If a doctor makes an error during your care and you are seriously harmed, you normally have the right to sue in court and have your case heard by a jury of your peers. This form takes that right away. Here is the critical legal distinction you need to know. Under the Federal Emergency Medical Treatment and Labor Act, known as EMTALA, hospitals with emergency departments must treat you in an emergency, full stop. If you are having a medical emergency, you cannot be denied care because you refuse to sign an arbitration agreement, so cross out that section on any intake form for emergency treatment without hesitation. For planned and elective procedures, the situation is different, and some providers may ask you to sign as a condition of non-emergency care. But before you sign, ask directly whether the clause can be removed or crossed out. In many cases, particularly with larger hospital systems, the arbitration clause can be declined or crossed out without any consequence to your care, and most people simply never think to ask. And if you have already signed an arbitration agreement at a hospital or care facility in California, state law gives you 30 days from the date of signing to revoke it in writing. Check your own state's rules. Document number 5 is the Insurance Auto Renewal Authorization, and this one costs seniors hundreds of dollars every single year through a documented industry practice called the loyalty penalty. Insurance companies are required by law to notify you of premium changes before your policy renews, But what they are not required to do is make that notification easy to read, easy to understand, or easy to act on. A renewal notice arrives in the mail, often a dense, multi-page document, and because most people have been with the same insurer for years, they assume the rate is roughly the same and let it automatically renew. This is exactly what insurance company pricing algorithms are designed to encourage. And those algorithms specifically identify long-term customers as the group least likely to shop around and most likely to absorb a higher rate. Studies consistently show that most seniors who take the time to shop around and compare rates at renewal find lower prices for the same coverage, and the savings are often more than $100 per year. The simple and powerful protection is to disable automatic payment renewal on every insurance policy you have, and then set a calendar reminder for 45 days before each policy anniversary date. Use that 45-day window to request competing quotes from at least 3 other insurers, and if your current insurer's renewal rate is higher than what competitors offer for identical coverage, call your agent and ask them to match it. That 20-minute phone call and those 3 quotes represent one of the highest return financial actions a person on a fixed income can take, and the savings show up every single month for the rest of that policy year. Document number 6 is the joint tenancy deed, specifically adding a child's name to your home as a joint owner. And this is the one I want every homeowner watching to listen to very carefully right now. When parents want to make it easy for their children to inherit the family home without going through the probate process, the most common advice they get from well-meaning friends and neighbors is to simply add the child to the deed. It feels like a kindness. It sounds simple and practical, and the intention behind it is completely pure. But it is one of the most financially dangerous things a homeowner can do, and here is exactly why. The moment you add another person to your deed as a joint tenant, they become a legal co-owner of your property right now. Not after your death, but today, this minute. And their ownership is fully exposed to their entire financial life. If your child is involved in a car accident lawsuit and a judgment is entered against them, the plaintiff's attorney can place a lien on your home because your child legally owns part of it right now. If your child goes through a divorce, their ownership interest in your property may be treated as a marital asset subject to division in the divorce settlement, and you had nothing to do with it. If the IRS places a tax lien on your child's assets for any reason, your home is one of those assets, and none of these scenarios require your child to do anything wrong. They just require them to be human. There is also a significant tax consequence that most families only discover after the fact, and by then, it is too late to fix it without a costly and complicated legal process to undo what was done. When you leave a property to your children through inheritance, they receive what is called a stepped-up tax basis, meaning their cost basis for capital gains purposes resets to the fair market value at the time of your death. If you bought your home for $80,000 and it is worth $400,000 when you pass, your child's cost basis is $400,000, and they can sell it immediately with zero capital gains tax owed on that gain. But if you added them to the deed as a joint tenant while you were alive, they do not receive the full stepped-up basis, and on a home that has appreciated significantly over decades, that difference can mean a capital gains tax bill of tens of thousands of dollars. The safe alternatives exist right now, and they accomplish everything parents are trying to accomplish without creating the legal co-ownership that puts your home at risk during your lifetime. A Ladybird deed, which is available in Florida, Texas, Michigan, Vermont, and West Virginia, lets you keep full legal control of your home during your lifetime and passes it directly to your children at death without probate. A transfer on death deed, which is currently available in approximately 33 states, works in a very similar way. You stay in full control, the home passes at death, and your child's creditors cannot touch it while you are alive. Both of those tools accomplish exactly what joint tenancy is trying to accomplish: skip probate and transfer directly, without the legal and financial exposure that joint tenancy creates the moment you sign it. So here is the full picture, and I want you to walk away from this video with all 6 of these things clearly in your head so you are ready the next time a clipboard comes your way. Do not opt in to overdraft protection at your bank, because a declined card at the register is free and a single overdraft fee at a major bank can run up to $35 per transaction. Look for your bank's arbitration clause in your account agreement, search for an opt-out process, and send that letter by certified mail to preserve your right to a court of law if you ever need it. Do not sign a surprise billing protection form at a hospital, because that form waives your federal protections under the No Surprises Act and shifts out-of-network costs directly onto you. Decline or cross out medical arbitration clauses in emergency intake settings, because under EMTALA, the hospital is legally prohibited from denying you emergency care no matter what you do or do not sign. Disable auto-renewal on every insurance policy you have and get competing quotes 45 days before every renewal date, because the loyalty penalty is real and the savings from shopping around show up immediately. And if you want your home to pass to your children without going through probate, use a ladybird deed or a transfer on death deed instead of adding them to your deed as a joint tenant right now. None of these institutions will sit you down and explain any of this to you, because the clipboard moves fast, and they are counting on it moving too fast for you to read what you are actually signing. Now you know exactly what to look for and exactly what to say before you ever sign any of these 6 documents again. And that knowledge is genuinely worth protecting. If this video helped you, please share it with a parent, a neighbor, a sibling, or a friend who is dealing with banks, hospitals, or insurance renewals, because one conversation about this can change someone's situation completely. Subscribe to this channel and turn on the bell so you never miss one of these, and I will see you in the very next video with more of what they are not telling you.